Hi, my name is Ed and welcome to the Experian Guide on how to improve your credit score. A credit score is a numerical indicator of how likely a business is to fail in the next 12 months. The score ranges from 1 to 100. The higher the score, the less likely the company is to fail, which means it's a sounder option. A credit score takes into consideration if a business pays suppliers on time, as well as historical information from lenders. This comes together to form a business financial history. A consolidated view of all this information equals the credit score. Your credit score is calculated using two sources of information: the details you submit on a credit application and the contents of your business credit report. Remember, credit comes in various forms. The most obvious kind is the credit extended to you through a commercial bank account. However, being given 28 days to pay an invoice is also a type of credit, albeit from another business or supplier. Your business credit report will have been compiled by a credit reference agency and includes your business financial history. The information will have been sent to the agency by businesses who you have a financial working relationship with or have had in the past. This includes any outstanding invoices or county court judgments, CCJs. A credit reference agency is a company that collates data from various sources, for example from payment information, electoral roll information, and finance arrangements. The credit reference agency then provides credit information on individuals or businesses for a variety of uses. In the UK, this task is entrusted to 3 carefully regulated credit reference agencies, for example, Experian. Your credit score is an indicator of your financial stability. An application for credit depends largely on an individual lender's criteria. Applications for different types of credit may be viewed differently. For example, an application for a vehicle lease would probably be assessed differently than one for business credit with a stationer. A credit rating is a recommended credit limit based on the size of your business, the way you pay your credit suppliers, as well as any published financial accounts. Being refused credit in one place doesn't necessarily mean that you'll be declined in another. This is because your score, as mentioned earlier, is considered on a case-by-case basis by individual companies, depending on the level of risk they're willing to take. However, be aware, if you make multiple applications for credit, each potential lender can leave credit footprints on your report after scoring, which could indicate an urgency for financial help, and so reduce your score. Making applications for business finance leaves a trail of records on your financial history whenever a potential lender searches for your details. These are known as credit footprints. The more applications you make, the more footprints will appear in your business credit report. A long trail can give the impression that you're having difficulty getting approval from lenders. We've got tips on how to shop for finance without affecting your credit footprint, which I'll cover at the end of this video. Potential lenders, suppliers, and customers can use your credit report to gauge how much of a financial risk you present before working with you. If you are a director or named secretary, you can obtain your own company report from a credit reference agency for a nominal fee. A reputable credit reference agency should be able to offer a walkthrough of the report's contents and advise on how to improve it. Can someone improve your credit report for you? No. Be wary of any company which promises to repair your credit worthiness by removing bad debt on your records. If you find an error on your report, a credit reference agency will amend it for free, providing you supply a statement to support the alteration. You can shop for finance without leaving a credit footprint by asking for quotations instead of making full applications to potential lenders, when all you need is some idea of what they can offer you. A good broker will help you do this and only advise you to apply to lenders you have the best chances of securing finance with. Maintaining a healthy cash flow is a challenge, but the basics are simple. Plan for unexpected outgoings. Minimize your cash conversion period, the time between invoicing and getting paid. And negotiate longer payment terms with your suppliers than those with your customers. So, how can you improve your credit report? You should screen your suppliers to protect your business against non-delivery. This helps to avoid the knock-on effect if a supplier is late on release of goods, which could have an impact on your ability to fulfill services to your customers. You can identify customers who may be a credit risk by spotting those with a tendency to pay late, both before and after you first deal with them. This helps protect your business against bad debt and ultimately keeps your credit report clear. This, of course, helps make your business more attractive to lenders, just in case you need to apply for finance later. Hopefully that's given you an insight into how to improve your credit score. That's all from me. Now look out for more in this series of Experian videos for smaller businesses.